Welcome everyone. I'm sitting down today with Tony Sycamore. We did a previous interview a few months ago. I think it's been almost a year ago. And we're going to do a follow-up today. So welcome, Tony. How's it going today?
Very well, thanks, Eddie, and thank you very much for having me back on the show. And yeah, 12 months. I think it's been about almost 12 months since we last chatted. So we've got the business up and running now. It's 12 months in. We've had a few developments which have been exciting and some potentially exciting things going on. So all going well.
Love that. Yeah, it's great. It's 12 months. So what I really love about you is the fact that you're not only trading, but also building the business, which is really interesting. I think more people should definitely do that and get involved into that. And so we'll talk about a few different things today about how to trade Forex like banks are doing, because you've been working with some banks in the past. So, but
Yes.
I want to start first with kind of you introducing yourself, tell people who you are, what you do, and a bit of background.
Yeah, okay. So my background, I originally started on the futures floor in the mid 90s. I moved onto a trading desk when the Sydney Futures Exchange closed down, went electronic. I was managing a retail futures fund on it, or helping to manage a retail futures fund. This is back around the 2000s. And the firm that I was working for was later merged with Goldman Sachs. So we became part of Goldman Sachs, and they weren't too keen. Goldman Sachs weren't too keen on a couple of guys trading a retail futures fund. So they moved us down to prop trading, myself and my partner. So I was very lucky. I had the floor trading background. I was sitting on a retail futures desk, and I was soon to join the proprietary trading engine, which is Goldman Sachs. So I spent 6 years in the proprietary trading area at Goldman Sachs. I was originally trading equity indices and then later moved into FX. FX kind of became my thing, if you like, which is where I found that my technical background, using technical analysis, a blend of macro analysis worked best for me. And that was, I guess, brings me to where I am here today. We traded at Goldman's up until the Dodd-Frank rules and the Volcker rules finished prop trading effectively. I moved into an institutional sales role, originally with a French bank, BNP Paribas, and then I joined the Commonwealth Bank of Australia, where I spent 5 years up until probably about 18 months ago now. And one of the things I was doing at CBA was speaking to hedge funds and central banks and big fund manager type clients, but I was also producing a technical analysis report. And that technical analysis report got shortlisted in 2016 for one of the best, shortlisted in the category of best bank FX research. And then again in 2018, so after a year of being up and running, the Tech FX Traders got nominated or shortlisted by the Technical Analysis Awards in the best independent FX technical research house. So we've basically, what I've done is I've taken what I was doing at CBA and BNP Paribas and Goldman Sachs, the trading style, the technical analysis which I used, and I'm now bringing that, if you like, into the retail market, speaking to private traders and trying to show them what we used to do and how I used to do it. Not every trader trades the same, obviously. This is the way that I traded. It's the way I continue to trade. And yeah, just getting that across to the private traders, the people who are learning, and potentially people who are maybe been trading for a year or two and like to see some trade ideas, a second set of eyes on the markets that they're looking at. That's kind of what we're looking to do right now.
Love that. And for having been on your report for some time and reading through the trades and the setup you find, I think they're really in detail, really interesting. We'll talk about that a little bit more later with some examples. But I
Yes.
kind of want to hear about your trading style a little bit. So kind of what you trade, when you trade, and how much time that involves in your schedule.
Yeah, right. Okay. So as I mentioned, I started trading stock indices, and I soon found that FX was better suited to what I was doing. It was very technically driven, um, and that was very much where my background was. I love charts. I used to spend a lot of time on the futures floor learning about charts and understanding what made markets tick, if you like. So FX really resonated with what I did. And that's where I started making my money at Goldman's. And that's where I had my best years trading FX. So it was natural for me. Once you find something that works for you, you generally stick to it. I'm not saying that was all I traded. We did trade stock indices. We did trade bonds and gold and oil and things like that. But FX was pretty much, where I found my thing, if you like. And um, I now write so TechFX Traders is doing a couple of things. We're providing technical analysis report 3 times a week, so a big weekly report which I write on a Sunday, and then 2 midweek updates. We're providing education for clients. Have become partner, if you like, with City Index, the logo you can see behind me. So I'm providing education for City Index clients. Um, and I'm also trading myself, and that's something which I enjoy doing. And I'm trading based on the reports which I write, which is exactly the same methodology that I've used throughout the last 10 years of my career, if you like. So I'm looking at things in a couple of different ways. I look at charts from an Elliott Wave perspective. That was where I first learnt about technical analysis using Elliott Wave. I'm a big fan of candlesticks, so I like to incorporate candlestick analysis into my Elliott Wave analysis. I use things like trend lines. I use divergence. Trend channels, all that type of traditional stuff, which people may or may not like. I don't mind whether you like it or whether you don't like it. I use it my way, and that's either going to make me money or lose me money. I'm very, very particular about my risk management and my money management. But yeah, that's the way I look at it on the first level, if you like. And then I look at other things. I look for FX. There's other drivers of FX markets. There's, for instance, what's happening with the commodity markets. What are the terms of trade of the respective markets that we're looking at doing? If you're trading Aussie, what's happening to the copper price? What's happening to iron ore? What's happening to LNG? If you're trading the Kiwi, what's happening to dairy? And behind that as well, we need to understand what's happening with interest rates. We had interest rates in the US and now sitting well above interest rates in Australia. So looking at a various cycles, we're looking at intermarket relationships, and we're overlaying that into the whole mix to try and find profitable trading signals, if that makes sense.
Love that. So quite complex maybe for someone starting out, but this is what you develop over time. And I think there's a lot of details into that we could talk about. But I'm kind of curious about, because a lot of people use candlestick to trade or to analyze a little bit the chart. What are the things you look at in terms of candlestick? Is it one candlestick setup, or is it like a whole different subject?
Yep, it's candlesticks. I first came across candlesticks about 15 years ago when I was working at Goldman Sachs.
Mhm.
I was very fortunate to meet a gentleman by the name of Dan Gramser. And Dan was teaching some for the Australian Technical Analysis Association. Dan came out and was doing some seminars, and I attended a couple of Dan's seminars. And Dan had a very similar background to me in that he was a floor trader in Chicago. He was one of the pit traders. And the way he explained candlesticks to me, not to me specifically, but to the people at the seminar, really struck a chord with me, because he's explaining how those emotions, the dynamics which we used to be able to experience and see and hear on the futures floor, were then portrayed in a charting sense through candlesticks. Um, so I loved that. I loved the way that Dan explained it, and I've been using candlesticks ever since. And I'm very much, well, I would say, a disciple of what Dan taught me. I had Dan. We actually brought Dan into the Goldman Sachs proprietary trading room for a full day's seminar to teach some of the traders there how he looked at candlesticks. And I've added a few things of my own, but I'm very much, well, using a lot of the stuff which Dan taught me. And the way I explain candlesticks is the way Dan explains it. There's probably 70 or 80 different candlestick types, candlestick patterns. And you can go through and you can learn the first 65, but by the time you get to the last 5 or 6 and you're writing down and memorizing what they mean and what they look like, you've probably forgotten what the first 20 or 30 that you learnt were. So I prefer to focus on probably a handful of candlestick types: reversal candles, which also go by the name of pin bars, loss of momentum candles. I like looking for dojis, but essentially I'm looking for candles which I think can give us a sense that a trend has potentially run its course and we've got a possible reversal. At the very least, we've got a loss of momentum happening in the market. And then I blend those candlesticks into my Elliott wave analysis. I might put other sorts of overlays in there, trend lines, trend channels, etc. But candlesticks for me, I don't think you can use them as a standalone trading system. A lot of people will try, and I think they'll probably find that it isn't quite as successful as they'd like it to be. But when you bring candlestick analysis, this is for me, this is my personal experience, and there's many, many ways to trade. I'm not saying my way is the right way or the wrong way, but when you start to bring your candlestick analysis into the framework which you might already be using, I think it can be very, very powerful. And by definition, if your trading is based off two or three different methodologies all gelled together, all those signals are saying the same thing, I think you're going to get potentially better trading outcomes and better profitability. So that's the way I like to think about candlesticks and how I use candlesticks.
That's great. I'm kind of curious to know, has there been a kind of a change or some things that you do different since going from trading in big institutions like banks to trading by yourself? Did that remain the same thing, or did that change a little bit?
Look, I'm still trading the same way. I'm still very disciplined with how I approach a trade. I don't ever risk more than 1% of my account on a trade, which a lot of people, in my experience, um, you'll hear of stories of people opening up, and this has been an eye opener for me because I've only really been in this space for 12 months. But I'm hearing stories about people opening up trading accounts with $2,000, for instance, and the very first trade they take, they risk $200. And $200, look, let's be honest, Eddie, you go out with your girlfriend or your partner, whoever, you go and have a nice meal, a steak and a bottle of wine, and you've dropped $200 straight away. But $200 is also 10% of that $2,000 trading account. And if you have 5 losing trades in a row, you've lost 50% of your trading account. People don't do the maths behind what they're doing. If you've lost 50% of your trading account in 5 trades, you need to make 100% just to get back to scratch. And it's not easy to do that. I mean, most of your big fund managers who are trading in currencies and whatnot, they're pretty happy right now to make somewhere between 10 and 20%. They're not looking to make 100%. Sure, you can go out there and try and make 100% in 1 year, but I can guarantee that in year 2 or year 3, if you're trying to make 100% every year, you're probably not going to be around after 5 or 6 years. It is a game which has a short lifespan if you're going after those high risk, high return type trades. So I'm very, very structured with the way I treat my trades. For me, there was a bit of getting used to not having Bloomberg. Bloomberg is a fantastic terminal, which all institutional traders have. We're very, very lucky. I mean, if you were sitting in a trading room, you would notice that every one of the traders would have a bank of 6 or 8 screens, and on at least half of those you'd have Bloomberg, and you got all the information you needed in terms of data coming out, data expectations. If you're a stock trader, you got EPSs. All sorts of information was basically at a fingertip. With where we are today, being in that retail private trader type environment, it's not as easy. I mean, when you talk about Bloomberg, it's $2,500 a month. Now, that's a massive overhead that you've got to cover if you did want to go out and get Bloomberg. So I'm using TradingView. I found TradingView to have wonderful charting functionality. I cannot I've been actually feel very lucky to have found TradingView because I tried a number of different charting systems, but this is a reasonably priced product. The charts, you can save your charts, you can do all sorts of stuff. So I've had to basically try and replicate what I had at Goldman Sachs, but on a much more sensible budget, if you like. And that's one of the biggest things. But look, I'm looking at the same things. I'm looking at what's happening with candlesticks, Elliott waves, what happened to interest rates last night. We know the Fed raised interest rates. They put the benchmark rate into the range of 1.75 to 2%. Actually bonds finished, or interest rates actually finished a little bit lower on the day after spiking higher. I'm looking at what's happening in interest rates. I need to know what's happening to equities, because equities are such a big driver of markets. We saw in February, we saw the S&P, 2nd of February, we saw what happened when interest rates started to scare the equity market there. We, all of a sudden, US 10-year interest rates broke through 2.6%, found themselves up north of 3.1%, and the equity market didn't like that. And there's a reason for that as well. People don't understand the rationale behind this. But if you've got a 2-year bond in the US yielding 2.5, 2.6%, and the dividend yield on the S&P is 2.1 or 2.2%, whatever it is right now, you can safely park your money in a 2-year bond and earn 2.5%, as opposed to putting yourself at risk by putting money into the stock markets after a very, very strong run up and earning 2.1%. So if you were to put money into the stock market over the bond market right now, you've got to be very, very confident that stocks are going to continue to go higher, which I don't think people can confidently say right now. We do know that interest rates are going up in the US. We know there's another 2 tightenings at least coming this year. There's potentially 4 coming next year. What does that mean for stocks? And I don't think people think about this framework as much as they should do. So all those sorts of things, what's happening to iron ore, what's happening to copper, what's happening to interest rates, what's happening to the S&P. I'm trying to take all that into account and gel it together into a discretionary trading framework, Eddie. And so there's a lot to go on, and I obviously can't go into cover all of those particular nuances in my report. I mean, the report I put out by 8:30, 9 o'clock each day. I try and give people the key points, what I'm looking at, the key levels. And if I see a trade idea that I like, I then highlight that. I put a stop loss in, and where the profit targets are. I'm very, very keen, and more so trading my own money than I was with Goldman's. I like to scale out of trades. So as soon as I get a trade, if I'm, I try and work in multiples of 3. So if I'm working if I've got an order, so let's say we're short dollar yen, and I am short dollar yen at the moment around 110.20, and I've got a stop at just above 110.85. So I've got a 65 point stop on, if you like. Now, as soon as dollar yen drops 65 points, or a 1-to-1 type ratio, I'll take a third of that trade off. And if it drops another 40 points, I'll take another third off. And I'll keep the last third until my target in dollar yen. This isn't a trade. This isn't trade advice. This isn't trade recommendation. This is just the way I trade. So I try to scale out of trades, because it's important when we are trading for ourselves to make sure we pay ourselves at the end of each day if we possibly can, because there is going to be days when you aren't paying yourself and you are going to lose money.
Yeah, this is a really good lesson, especially for the cash flow coming in and the less stress you have also of having a big target. I think this is really good. Now, is there a reason for having 3, let's say, position, or like dividing trade in 3 parts, or is it what you prefer, or for some reason? I don't know, because I used to for myself. So I'm kind of
Yeah,
curious.
look, I think the way I like to do it, and the way I rationalize it in my head, at the end of last year, we were getting a lot of false moves. We thought volatility was very low, it was being compressed, interest rates were still sitting in a range, and we had a lot of false breaks. A lot of them came about from the missile tests in Korea. We got some very big sharp moves, but they just retraced by the end of the day. And I missed a lot of that. I missed taking profit after that. On a lot of those moves, and I should have, in hindsight, I should have locked some profit in. So that taught me it reminded me that, hey, look, we're in this game to make some money. Why I use thirds is just, for me, I try and take off 1/3 when it hits the 1 risk reward ratio, and then I try and keep the remaining 2/3 for some, I might take the next third off where there's a decent support level, and I try and keep the last third. It's almost like a blue sky type trade. You've got to let your profits run. That is true, but you've also here to make some money. So I don't want to sit here dreamily thinking that dollar yen's going to 104 or 103 if I'm sitting short at 110. If it gets to 108.50, even if it gets to 109, I'm probably quite happy about that. So I think we need to be realistic. Look, people tell you to go and put on 3-to-1 trades and 4-to-1 trades, and that's fine if you can, if you can find them, that's fantastic. But for me, I'm happy to take a 1.5 to 1 trade, or a 2 to 1 risk reward trade, because they're going to come around a lot more often than that big 5 to 1. Hey, I'm going to belt it out of the park type trade, which, they're good trades. Don't get me wrong, but they just don't come around that often.
Mhm. But I really like that you combine both a fixed royalty risk and a place in the chart, like a specific level, because for me, that's exactly what I do. I prefer to have like fixed levels, but I like the combination of both. So that's interesting.
Yeah, I think you've got to be flexible in trading, and that's what this does. It gives you flexibility. I, I had and one of the things we're doing is also Tech FX Traders is doing is one-on-one type, education. If someone's having problems with their trading, they call me up, say, look, I'm having some problems. And I spoke to a chap the other week, and he said to me, listen, I'm doing, I've spent thousands and thousands of dollars on courses. I said, okay, tell me what markets you're trading. Tell me how you're trading. And he had a wonderful understanding of markets. To me, I was really, really surprised that this chap wasn't making money. And I said to him, look, you're getting into the trades in the right way. You're putting the right trades on. I don't understand how you're not making money. I said, can you tell me a little bit about your exits? And exits are the most discretionary part of trading. I mean, you've spoken to hundreds and hundreds of traders. People have got pretty fixed reasons and rationale for getting into trades. But when people tell you how they get out of trades, I don't think you probably can cover all the different potential outcomes. I mean, some people might just work a fixed trailing stop. Some might never move their stop. Anyway, this chap was getting into some really good trades. And I said, so where are you taking profit on these trades? Have you thought about locking in a little bit of profit? You've got a 60-point stop on. The Aussie's gone already 60 points in your favor, but then it stopped you out and you lost 60 points. What if you took half of that trade off at that 60-point profit target? You can either lower your stop or you can keep your stop where it is, and then you've got a free trade on. But he hadn't thought about the mechanics of the exit. And it's probably the most important part of trading. And it is probably the most discretionary part of trading. And, just a simple thing like that. I said, listen, call me up again if you have any problems, but I think this will fix your problem. I never heard from him again. He said, thanks. I'll be in touch if I have any more problems. Boom. Haven't heard from him since. So I'm pleased that he's obviously found, what the missing element of his trading strategy was.
Yeah, and we have to talk about the fact that we have to like minimize the risk. And I think people think this is only by like trading small positions, but there's also the take profit aspect. If you just aim for high reward and you lose most of your trades, then it's not going to be really worth it. So I
That's
think that's
right.
another way of minimizing your risk,
Oh
which
yeah,
is
absolutely. I mean, you hear stories, people, I'm only going to put a 5 to 1 trade. I'm only going to put a four to one trade on. Well, the chances of a 5 to 1 or a 4 to 1 trade actually paying off is probably 10%. Maybe 20% at most. So you got to be realistic, and those trades just, they don't come around that often. You look at gold. I've got gold in the chart in front of me, and I apologize if I'm looking up at the screen. I've just got a couple, dollar yen and a couple of other things I'm looking at, but some of these markets just aren't moving. Gold really hasn't moved in 6 months. We had those highs up there at 1365. Yeah, we broke down below 1300, and I thought we'd probably break lower once we got that push down through, at least 1280. But it just bounced straight back higher. And unless you've been on some of those trending markets, crude oil's been a very good one. Aussie's really done nothing. Euros, obviously, there's some pretty big moves in the euro, but unless you've been fortunate enough to catch these moves, there's been a lot of markets fairly sideways, which when you're looking for a 5 to 1 trade, you've got to make sure you've got, you're on that trade, and B, that you're on the right market. So it does make it a little bit challenging.
yeah, definitely. I want to hear more about your routine, kind of what you do on a daily basis. So do you have any specific routine for you placing your trades, or looking at the chart, or and then what do you do after?
Yep. So I'm up most mornings around 5:30, 6 o'clock, either to write my TechFX traders report or to start doing, I always, doesn't matter what I'm doing. I always start by reading through. I get some research from start reading my research that I've got overnight, looking through the markets, looking at charts which might catch the eye. And that takes probably about an hour of my time, just going over the broader picture of what's going on, putting the news, and putting the charts together. And then I'll start doing if it's a Tech FX Traders, a Tuesday or a Thursday, it's a report that I put out for my clients. And on a Monday, Wednesday, and Friday, I'm looking at different markets to put ideas out for City Index, City Index clients. So today I wrote an article on Westpac. Previous day I wrote an article on AMP. Into the end of last week, I wrote a story on Aussie and copper. I'm just trying to find things which I think are interesting, which the market may or may not have got hold of. So I'm pretty disciplined. I spend probably between, those early hours between 6 and probably around midday, either researching, writing, trading, looking for trades. And then I try and get out in the middle of the day. I might go for a paddle or go to the gym. Today I went to the guys on the spot desk used to laugh about this, but I went and did yoga today. I love yoga. Being fairly old and inflexible, it's a good activity to do. And then I run around. I pick the kids up from school around 3 o'clock. And then I run around, do some sports activities with the kids, and then I'm back online trading at night. So it's regimented. It's not the same every day. I've got different things which I'm doing. I've got the arrangement I have with City Index. They want me to write a certain amount of articles per week, which is going really, really well. So yeah, the clients are liking it, and I'm enjoying doing it. And potentially we've got interest for their affiliates in China to receive some of our stuff. And I do webinars on a Wednesday night. Most Wednesday nights, I'm doing webinars for City Index, a Learn to Trade course and a Trade Like a Pro course. So in those courses, the Learn to Trade is base some of the basic stuff, looking at some trend analysis type stuff, how a candle's constructed, and then we're put together to build a trading system. Then the Trade Like a Pro series, we're looking at some pretty funky stuff. We're looking at some of the intermarket relationship stuff, which I've chatted about. I go into the Elliott Wave framework that I use, and I also look at some, and then we finish off with some interesting stuff on how to trade around news, what seasonal patterns can be observed in certain markets. And I also like to look at what's happening with the commitment of traders reports. I like to know how the market's positioned. So I share that information. That's with the City Index clients. And yeah, it keeps me busy. I've actually wish I had more hours in the day. I just not getting enough time right now to get all the writing that I'm trying to do, all the education and all the trading. But my actual trading, this week I've taken one trade, for instance. Actually, I've taken two trades. I bought some AMP. I liked that trade idea that I put out yesterday, so I bought some AMP. I've been a little bit bearish CBA for a while, and CBA's broken some pretty big levels. So I've got a bit of a relative value trade on in Australian stocks. So short CBA, long AMP. Westpac, I think, is pretty close to breaking down, so that's a trade I might put on over the next few days. And dollar yen, was a trade which I put on this morning, short dollar yen. But when you've got a week like we've had this week, we've had the G7, the aftermath of the G7, and President Trump walking away, coming back, and then signing, and then saying it didn't happen. And then you had the meeting with Kim, and then we've had Australian employment data. We've had the federal, we've had the Fed tighten interest rates. We've got the ECB in a few hours. We had China data today. When you're trying to negotiate some of those huge data events, which all are clustered in a 1 week period, I generally try and just keep all my trading away. I don't take big trades over data. I try and avoid trading over data as well. Whereas with my stock trades, my AMPs, my CBAs, it's not really data dependent. It's there's a few other fundamental drivers that I'm looking at there, and some chart patterns as well.
Interesting. I'm curious to hear about the reports or the news you look at in the morning every single day. Do you have like specific sources you try to see different things? What is it? What is that like?
Yeah, I've got I do. I always look at the Bloomberg website. I'm big into Twitter. There's some really good people I follow on Twitter. but yeah, I get some good emails as well. I still manage to get some research from old colleagues and whatnot who pass on, stuff to me, um, which I find interesting. But it's just filtering through all that information, and that's, to be honest, without a Bloomberg, that's probably the biggest challenge that I have. So if I'm writing an article, there's just not one central pool of information that you could usually, if you had Bloomberg, you could just type it in and it'd all come up for you. Everything would come up. But I do a lot of Googling. I do a lot of Bloomberging. Um, Bloomberg, just the website, Reuters, the website, all of those institutional websites, I think are very, very good. You can get a certain amount of articles for free. You can subscribe if you want to. Um, and yeah, that's pretty much where I'm getting. I mean, even turning on Bloomberg TV is, I find that can be, if I'm looking for an article and I'm absolutely stuck, and I have been stuck before, I turn on Bloomberg TV and something just comes through like that. It's really good.
That's interesting. So for people wanting to do that on their own, retail traders, it's still possible, but they have to find the right sites and resource, I guess.
Yeah, and they have to know how to use the information as well, Eddie. And that's one of the things
Yeah.
I keep saying to people. People say, where do I start? And I say, well, look, start by learning about the charts, because the charts are going to give you, price is pretty much, well, at the end of the day, one of the best guides you can have for what's happening in a market. But people say, well, I like, how you use macros. I like how you use your intermarket relationships. And look, it's great. And, I can't recommend it highly enough, but it takes a little bit of time to actually get to learn to use. And I tried purely trading technically for a lot of years, and at best, I was slightly profitable. As soon as I started looking at other things, um, then that's when my profitability started to increase. And I remember a chap by the name of Larry Williams, and I was lucky enough, you might have come across Larry Williams in your travels, but he was a fairly famous educator probably about 15, 16 years ago. His daughter, Michelle Williams, married Heath Ledger, fairly famous family. Anyway, I attended two of Larry's seminars in Sydney in, I think it was 2000 and 2001, either side of the tech wreck anyway. I remember that quite clearly. But one of the things, and I won't go into whether his teachings were any good or not, because the tech wreck certainly showed a lot of people that markets don't go up forever. But what Larry used to say, and I still remember this, and I still respect what he says, in terms of, he used to say, look beneath the charts to see what's really going on. So if you're just looking at a daily chart of gold, you're getting one part of the picture. If you're looking at daily chart of dollar yen, you're only getting one part of the picture. So for something like dollar yen, I need to know what's happened to US interest rates. I need to know what's happened to risk markets, which are the equity markets. If I'm trading the Aussie and I'm just looking at the daily chart and I don't flip over to see, hey, listen, geez, copper's just rallied 10% over the last 2 weeks. Why is copper up 10%? Okay, well, there's a potential strike going on over in Peru. In Chile, one of the biggest mines in the world, is potentially 5% of the copper supplies come from this mine. The price of copper's rallied 10%. Okay, what does that mean for the Aussie? And if you do an overlay of the Aussie dollar versus copper, you will see they're very, very, very closely correlated. You can get some data which can give you the actual correlation. In fact, TradingView does it. I mean, it's just got so much functionality. That you can get that sort of information off these platforms. So okay, copper's up 10%. Hang on, I wonder why the Aussie's not going down at the moment. Well, okay, there's one of the reasons. Copper is very, very strong right now. So all these little snippets, you need to know where to look. I mean, for the Canadian dollar, crude oil is very, very important. For the Kiwi dollar, I mean, they're the world's biggest exporters of dairy products. So we need to know what's happening with milk prices. So there's all these little things as a bank trader you pick up, but there's no reason why people sitting at home like you or I are now can't look at these markets. It's just, where do you get that information from? It's not easy. Where do you get that education from? Well, it's not easy. Hopefully some of your folks listening tonight will take some of those things on board.
Yeah, and I think this is where the value of subscribing to like a report or someone knowing that before can be useful, because then you start to pick up some things that is written that's in the report that you do, and then people can start to understand, oh, this pair moves with this thing, the interest rate or whatever thing you could look
That's
at. So
right.
that's the value, I think, which is really interesting.
Yeah. Yeah, that's what I'm trying to do. I'm trying to, and I don't. It's impossible to bring in all the different, you know, influences into a 2-paragraph
Yeah.
report each morning. And it's only 2 paragraphs on each of the currency markets. It's not 2 paragraphs overall, but I try and write 2 paragraphs on each currency pair, because currency pairs, and that's the other thing, like people will sign up and they'll go, oh, okay, you're not trading enough stock indices, or you're not trading enough crypto, or you're not trading enough bonds or oil. And look, I was trying to cover as many markets as I possibly could when I first started. But then I just realized, look, that's not what you're about. That's not what this report should be about. This report should be about, hey, I spend a lot of time trading the Aussie dollar and the Kiwi dollar and the euro and dollar yen, and the cross rates which come from those. That's what I've always done. That's where I feel like I have an edge. So for me to then go out and do a whole heap of stuff on, for instance, the DAX or the CAC, it's not. I always look at the S&P. I want to try and stick to the markets which I trade and which I feel like I have an edge. So yeah, I don't. At one point in time there, I was trying to be everything to everybody, but now I just say, look, these are the markets I trade. Sign up for a trial if you like. If that suits, if those markets which I'm trading are the same markets which you're trading, fantastic. If you're interested in learning about those markets which I'm trading, fantastic. But hey, these are the markets that I cover. I don't have time to write about 50 different markets each morning. So that's I'm comfortable with that. It probably turns a couple of people off, but by the same token, I think people like that. Hey, look, he's sticking to the markets where he feels like he has an edge, where he can make some money, and hopefully the trading results are proving that as well.
Yeah. And one thing I've seen with different reports online, either some are free, some are paid, but it's the fact that they only show you kind of the analysis of what the chart looks like, what it's about, but they don't tell you about the trade. So you understand what's happening on the chart, but you never know when to put a trade, which is the reverse for you, because you show people where you would take trades, what happened with those trades, and I think that's really where the value is also.
Eddie, and I agree. Look, technical analysis is a wonderful, wonderful field, but just because you can do technical analysis doesn't mean you can trade.
Yeah,
And that's probably
definitely.
been my
Yeah.
biggest challenge when I sit down and write a report. Okay, here's where I think the markets are. Um, but can I see a trade there? And when I'm thinking about can I see a trade there, I'm thinking about it in terms of risk reward. Is this trade going to pay us to get into it right now? What data have we got coming out? I don't trade over data, as I mentioned, very much at all, because I don't feel like I've got an edge in trading over data. I mean, a lot of the data series are flip a coin. You've got data coming out today in China. They had their retail sales out. They had IP come out. The data that came out today was for last month. So you're telling me that China can get all the data for its 1.6 billion people in 2 or 3 weeks after the end of the month? Come on, it just doesn't happen like that. We've got to take that data on face value, but I don't know. I mean, the numbers aren't real. The numbers are whatever people want it to be. They can't possibly go through there and measure everybody's retail spending over the last month. 2 weeks later, it just can't happen. So we need to be aware that trading over data, even when we're looking here in Australia, Eddie, and the Australian Bureau of Statistics, which presents and collates a lot of the data we use to trade, successive governments have cut the budget to the ABS. So we're getting smaller sample sizes, which means we're getting more volatile data. How can anybody trade that? It makes it difficult. So unless I've got a really high conviction view on a market and a trade, I try and avoid trading over those big data series, particularly the tier one data.
If you're not on data, what would you trade on? Is this like an overall situation or issue that is happening in a country or something like that?
Well, I mean, I always have my backdrop, I always have my framework, but then I think, can I justify? And you were going back to the report puts in trade ideas. It doesn't put trade ideas every day, and it doesn't put trade ideas on every market. I put a trade idea down when I can see a trade which
Yeah.
I'm going to take. But I often won't take a trade, like I mentioned. I'm not going to trade when Kim's meeting Trump, or when the Federal Reserve's about to jack up interest rates, or when the ECB are talking tonight, or Australian employment data. I mean, I thought the Australian employment data today would be much weaker than it was, but it was a bit of a mixed bag today. We had unemployment rate kicking down to 5.4%, but when you look at the actual jobs created, we've had no jobs created here since the start of 2018. So it was a real mixed bag today. But I try and avoid, I don't mind not trading. I don't feel like I'm one of those people that has to trade all the time. If I trade once or twice a week, I'm fine with that. If I don't trade in a week because I can't see a trade, well, look, sometimes I've had clients come to me and say, look, you don't trade enough. And I say, well, I can trade more, but you're going to potentially be doing trades which I think are marginal at best, and which may not make you money. So you either decide that, hey, we trade a little bit less frequently, but we trade the trades we really like, or we can trade a lot. I can give you 5 trades a day, but whether they're going to make money or not, I very much will doubt it. So again, I'm comfortable with what I'm doing. I'm comfortable with the process, and the people which are signing up to receive our report seem fairly happy with it as well. At least I think they're happy with it. I hope they are happy with it. I'm putting my heart and soul into those trades, and I'm backing those trades myself. One of the things I am doing is trading an account off the back of the trades, and from Jan 1 this year, we're up about 7%. Now, that doesn't mean anything about going future, past performance, all the usual disclaimers, doesn't mean anything about future performance. But I hope to have those results up on my FX book, and people can follow say, well, look, that's how he's trading. He's using those reports. Maybe it's worth me investing in those reports. And they're not expensive. It's $55 a month. If you get 3 good trades a month, one of those, 3 or 4 good trades a month, I like to think that one of those trades is paid for the, more than paid for the report. So, that's the way I see it.
Definitely. And we'll put the screenshot of the report right here for people to see, and we'll have a link in the show note or below the video for people to subscribe if they want to subscribe. Tell people what is in the report exactly.
Okay, so what's in the report? So my big weekly report, I go through, it's about 28 pages long. I go through the monthly and the weekly, and then sometimes the monthly, sometimes either the monthlies or the weeklies, I should say, but always the dailies. So I go to the bigger time frames to get a perspective of what's going on, where a market's been. Is it cheap? Is it mid-range? Is it the top of the range? Is there any big levels up here we should be aware of? In a piece that I wrote for City Index probably about a month ago, I went through and highlighted the reason why the $72 to $73 level in crude oil was super, super important. And this was off a monthly chart. And crude oil, if you're familiar with the crude oil chart, crude's backed off from that $72 $73 level and now sits around $66.80. So I look to see where the big levels are on the monthly and the weekly charts, and then I'm trying to find entries on the daily time frames. So I'll provide what I do with these markets, and as I mentioned, it's the weekly report will basically start with your Aussie, Euro, Kiwi, Aussie, Kiwi, Euro, Aussie, Sterling, Dollar, Yen, and maybe something like Aussie yen or Kiwi yen, Euro sterling, if I can see a pattern there that I like. I also cover the S&P, the DAX, and 10-year interest rates, crude oil, and gold. So it gives me a fairly good overview of what's going on. That's the big weekly report. In the subsequent updates on a Tuesday and Thursday morning, I'm probably looking just at refining the ideas on potentially the 6 or 7 markets where I can see trades potentially happening. So the weekly report is like a big broad overview. We're looking at weeklies, we're looking at monthlies, we're looking at daily charts. We're looking at what interest rates are doing for in terms of how it might affect dollar yen or how it might affect the Aussie. And then we're trying to break it down into sort of more detailed information, which hopefully we can extract some trades from and then update during the week. So I provide a bit of a technical overview, and then as I mentioned, if I see a chart and a technical setup where I think the risk reward can justify a trade, we'll then look at a trade idea. And I call it a trade idea because I don't want to sort of, it's look, it is I'm trading them. Whether you want to call it a trade or a trade idea, I don't really mind, or a trading view. But if I have a trading view down there, it means I'm looking to take a trade in that particular product.
All right, and you also give your stop loss, take profit, and all in detail, which is awesome.
Yeah, absolutely. I always put a stop loss in. I mean, I've actually, crude oil is a market which I'm short now, and I have a stop loss in crude oil, which is not that far away now. So I always have a stop loss in. I'm short dollar yen, that's working all right. I have a stop loss in that. It's a little bit away from where my stop loss is. It's probably heading more towards where my profit target is, which is good. But yeah, I always have stop losses in. If I lose 0.5% or 1% of my account, it doesn't really matter to me. I'd prefer not to. But I lose a fight, but I still stay in the battle, if you like. So yeah, I always put in stop losses. I put in profit targets, and that's the way that professional traders trade.
Yeah,
That's the way I try and trade. So
yeah, really well said. So how can people find you if they want to connect with you or reach out after the podcast?
yeah, my website's probably the easiest way, Eddie. And if it's www.techfxtraders.com, I've got my contact details up there. I've got email details there. Any information which you want to follow up on, just shoot me an email. But yeah, very happy to answer any questions. There's options to take trials. You don't have to. I'm not going to look. There's no, if you want to trial a service, you can then go back through our past reports and see what trade ideas we've suggested and see how we've got out of those trades. So it's all very, very, very transparent. Yeah, that's the best way to do it.
Awesome, cool. So thank you so much for being here on YouTube today and the podcast. I appreciate it, and I will
My
catch you
pleasure.
guys pretty soon.
Thanks, Eddie, and great to catch up again. And great to have me on the show. Thank you. Thank you for having me on.